A very happy day to all of you, and welcome to the second video on corporate actions, where we will be looking at what is the role of the fund administrator when a company issues a rights offer. So companies all over the world issue rights offers as part of their additional capital subscription and fundraising. But the main point to be noted over here is that the rights offer is offered only to the existing shareholders. It isn't therefore called as a public issue because it's not available to the general public. Therefore, it's not an FPO. It is not a private placement because it's offered to the existing shareholders who may run into millions of shareholders across the country and the world. And therefore, it's somewhere in between a private placement and a public issuance. So let's take a look at what is the role of the fund administrator when it comes to the issuance of corporate actions like rights, especially with reference to what are the tasks that are involved, what is the action that has to be initiated by the administrator or the custodian so that the rights offer can be handled properly. I'm your learning partner Sushila Hariharan, and if you're interested in a career in global markets with respect to equities, fixed income, currencies, in the three aspects of operations, regulations, and settlements across four specific tasks: fund accounting, OTC derivatives, trade life cycle, and custody operations, then I urge you to subscribe to my YouTube channel, where I have already uploaded almost 60 videos on different aspects. I have tried to structure the videos numerically covering different aspects of these four dimensions, and therefore it will form like a lesson plan for you, making it much easier for you guys when you go for your interviews with many of the fund accountant companies or with global investment banks. As we've already discussed in the first video, a corporate action is an event that is announced by the corporate, it is approved by the shareholders, and materially changes the structure of the securities held by the custodian or the hedge fund. The corporate actions could be voluntary, mandatory, etc. If you want to know an overview of these corporate actions, then do take a look at video number 1. In this video, we're going to specifically talk about what happens when a company issues a rights offer to the existing shareholders. A rights issue is an entitlement to buy additional equity. Please note the term over here, entitlement, because very often when you're working in the fund, they will be using the word, this company has issued rights entitlement, that is RE. The entitlement means you are entitled to it. That means you have to do something over and above that. Okay? It doesn't automatically get credited into your account. It requires action from the hedge fund administrator or from the mutual fund administrator. Only then the entitlement will get converted into shares. The rights issue is offered only to the existing shareholders. It is not therefore a public issue, nor is it a private issue. It is offered only to the existing shareholders as a part of the capital raising activity by the company. Since the company already has shares that are listed on the stock exchange, it has something called as a market price already, right? So the existing shares are quoted in the stock exchange, there's a market price assigned to it, there's market capitalization, etc. So when the rights is offered to the existing shareholders, it is offered at a discount to the current market price. The fourth important point over here to be noted is there is something called as a rights ratio. We'll now take a look at what is a rights ratio. For purposes of the discussion, we'll be assuming that the hedge fund owns a share of a company and the company is issued a rights which is in the ratio of 1:5. Before that, rights is a voluntary corporate action. That means the voluntary corporate action means that the hedge fund can decide whether to participate in the voluntary corporate action or completely let it go. Okay, so it's not a mandatory corporate action, it's a voluntary corporate action. Like all voluntary corporate actions, if the fund wants to participate in the corporate action, they must inform that they want to do so. They must inform that they are keen to do so. Let's take a look at rights ratios 1:5. What do I mean by 1:5? Very important. People today, even after working in fund administration for many years, get confused. The first number 1 is what is your entitlement. 5 is what is your current ownership. Okay, so 1:5 means you're holding 5 and therefore you're entitled to 1. Remember, corporate actions ratios differ from rights to split to everything. Okay, so just take a look at this. In a rights ratio, which is 1:5, 5 is what you own, 1 is what you are entitled to. Okay, many people still make this confusion, get confused. It's okay to get confused, but now get clear. Okay, that's what the video channel is there for, to get clarity over confusion. Hari Hedge Fund owns 100,000 shares. I was so devoid of names, so I said, okay, let's call this the Hari Hedge Fund. The hedge fund owns 100,000 shares. The rights subscription price is $7. Okay. Therefore, my question to you is, what is the rights entitlement? Rights entitlement is the number of shares. Okay. So you're currently the hedge fund is owning 100,000 shares. That means they will get an entitlement to buy the shares at the rate of 1/5 of their current ownership. The rights ratio is 1:5. The current ownership is 100,000. The rights entitlement is 100,000 divided by 5. I know many of you all have already studied this in your accounting courses or in your BBA courses in graduate college. But remember, don't get confused, because this is the most common mistake made in NAV calculation. The first most common mistake, in fact 60% of the errors committed by fund accountants is in this, that is, they get confused between different ratios. Okay, so the rights ratio is 1:5. In the case of rights, that means the fund is going to get 100,000 divided by 5. They have an entitlement to subscribe to 20,000 shares. Remember this term, rights is an entitlement. RE is very important to understand. Let's take a look at the first scenario. Okay, what and all can be the options for the fund? The fund applies for all the REs. Okay, so the fund is entitled to 20,000 shares. The fund can pay $7 per share. They now pay $140,000. That is 20,000 multiplied by $7. So the hedge fund, the first choice that the fund can do is, because they own the shares, they can apply for all the rights entitlement. We already calculated the rights entitlement at 20,000. So they have to pay 20,000 multiplied by $7. That is $140,000. What is the second scenario? The second scenario is, the fund applies for more than their entitlement. I have taken over here a number like 30,000 shares. The fund can apply for any amount, okay, of entitlements. The company will issue in a particular manner. We are talking from the fund administrator point of view. So let's look at it from the investor point of view, not from the issuer point of view. So can the hedge fund apply for more than their entitlement? They can apply for more than the entitlement. Whether they will get allotted or not depends upon the oversubscription in the entire rights issue. That is not something that we're going to discuss now. So you can apply for any amount. Doesn't stop. Nothing gets stopped over here. Okay, except that you can't apply for more than the rights offer itself. The hedge fund applies for 30,000 shares. They pay 30,000 multiplied by $7, $210,000. Different countries have different methods of payment. In India, we have the ASBA method for rights. So different countries have different methods of payment. So this is the second scenario. In the first scenario, the hedge fund has paid for the entire right entitlement. In the second scenario, they have applied for the rights issue. Third, the fund applies for 10,000 shares. It renounces 10,000 entitlements. Okay. So over here we can see that the rights entitlement is 20,000. They apply only for 10,000. They renounce 10,000. Now this is the most important tricky one to understand. So they pay 10,000 for the entitlement multiplied by 7, that is $70,000. When they renounce, what is the meaning of renounce? The meaning of renounce is they find somebody who's interested in buying. Most often it would be the company's registrar and transfer agent who facilitates this itself. Okay, the transfer agent finds out who is not interested in buying, in subscribing to the rights, and they sell the rights entitlement to those who want to buy. So the hedge fund renounces 10,000 right entitlements and gets a renunciation price of $5 per share. Okay, they receive $10,000 multiplied by 5, $50,000. So this is the third scenario. They have part applied, part renounced. Now I have just taken over here, 10,000 applied for, 10,000 renounced. It could be 15,000 applied for, 5,000 renounced. It could be any combination. But when they renounce, they are selling their rights. They get some money by selling the rights. So this is all smart things that custodians do for the hedge fund, because here if the hedge fund is not interested, yet they are getting some amount of money by selling out the rights. The fourth scenario, the hedge fund renounces all the rights entitlements. Okay, they don't subscribe to the rights at all, so they pay $0. They receive a renunciation price of $5 per share from the broker. So 20,000 rights entitlements multiplied by $5, that gives you $100,000. So the company over here is actually earning money, okay, by selling out the rights. By the investor, okay, not the issuer. The investor is selling out the rights and therefore is earning money from the rights issue. So all this is done very, very smartly and efficiently by the brokers, the custodians, the transfer agents, because over here a rights should not go waste. The rights entitlement should not go waste, okay, from the investor's perspective. And at the same time, from the issuer's perspective, they need to collect the money, right? So they will collect the money for the rights issuance. Okay, so these are the four scenarios. The company has, the investor has applied for the entire rights. The investor has part applied, part renounced. The investor has over applied, and the investor has renounced all the rights. Okay, so these are the four main combinations that could happen from the fund administrator point of view. Now let's take a look at the dates that are important. I've already briefly discussed the dates in the previous video number 1, but I will explain it very specifically with an exact example over here. What do we mean by entitlement cum rights? Cum means cumulative, it includes, okay, so this is a short form. From the time the company has announced the entitlement till the X date, investors holding the shares or buying the shares will get the entitlement. This is very important to note. So the price that is quoted on the stock market of that stock includes the entitlement, okay, from the announcement date to the X date. X rights. X rights means from the X date onwards. All right. X rights is a single date. All right. From the X date onwards, it is X rights. It does not include the dividends. The record date is the date on which, if your name appears as an investor in the transfer agent's books, then you are entitled to it. So this is the date merged along with the previous date, that's the X date, which is the most important aspect of stock exchange versus record dates. So here we integrate understanding the settlement cycle of the stock exchange, that's the rolling settlement cycle, with the record date of the issuance. So let's take a look at some of the dates over here. Understanding the X date and the record date. So over here I've just given you a calendar of 2022 September. The US stock is listed, the record date is 16th September. Okay, the first case example, the US stock is listed on the NYSE. In most systems nowadays, X date is automatically generated, but this is because you all are going to go for interviews. A typical question that is asked during an interview is, what is the next date, and what happens if the market is T+2 trading, what is the X date, is there a formula, etc. And this is for that purpose only. Otherwise, if you are already working in the fund administration industry, you will understand that the X date is automatically filtered into by the stock exchange. The stock exchanges and the companies announce the X date at the time of announcing the corporate actions. Let's say the record date is 16 September. Now I go to the calendar. I don't want you to open your mobiles and check the calendar. You can have a direct look at the calendar. That's going to happen now in September. 16 September is a Friday. Okay. Let's say the stock exchange, New York Stock Exchange, operates on T+2 basis. Okay. So the date on which it becomes X is T, the record date, minus 1. Okay. That is 15th of September. Is this clear? That means up to 15th, it is cum rights, C-U-M rights. But from 15th onwards, it will be X rights. So if you're a shareholder who's bought the stock on 14th, will you get the entitlement? Yes, you will get the entitlement, because as on the record date, which is 16th of September, you would have got the ownership because of the T+2 rolling settlement cycle. Most markets in the world operate on T+2. I've checked from the global markets team. There are very few markets that actually operate on T+3, and at least the developed markets. And T+1, there is, other than India, which has just started off with a few stocks in February 2022, nobody has actually experimented with T+1 because of the pressure it puts on the settlement systems. So let's take a look at the second example. Stock is listed on the London Stock Exchange. The record date for that particular stock is 5th September 2022, which is a Monday. Okay. So the X date is, in your formula, record date minus 1, right? But record date minus 1 is a Sunday, which is a holiday. So the markets don't work on Sundays. The record date minus 2 is Saturday, which doesn't work again. So the record date minus 1 formula continues because it's record date minus 1 working day. It has to be a listing markets day, and therefore the X date is 2nd of September, okay, which is a Friday. So this is how record dates are announced, X dates are announced, but the actual integration or the relationship between X date and record date is typically record date minus 1 if it's a T+2 rolling settlement cycle. What is the TERP? The TERP is also called as the temporary X rights price. Okay. So one of the actions that the hedge fund must do on announcement of corporate actions by its investment companies is to calculate the rights entitlement as well as to calculate the TERP, excuse me, which is the temporary X rights price. Let's say the hedge fund owns 100,000 shares of Marvel at $10. Marvel announces the rights in the ratio of 1:5, subscription price of $7. The fund's rights entitlement is 20,000, 100,000 divided by 5. They pay $7 per rights, and the amount paid is $140,000. This is the basics that we've already discussed till now. How do we calculate the TERP? Okay, the number of shares rights is 100,000. The price per share is $10. The value of the investment is $10 lakh. Okay, so that's $1 million. 100,000 multiplied by 10. The rights entitlement is 20,000. You have applied for the rights. That's why if you're not going to apply for the rights, you should not bother about the TERP. But if you're going to apply for the rights, then the number of entitlement is 20,000 multiplied by 7, $140,000. So post rights, the total number of shares held by the fund would be 120,000. The market value would be $11,40,000. So $11,40,000 divided by $120,000 gives us 9.5. Okay. So how do we get 9.5? It's the market value, that's $11,40,000 divided by $1,20,000. This is how we calculate TERP, that is the temporary ex rights price. So the price is now a derived or a calculated figure. Okay, and then the TERP would be valued at, the TERP is $9.5, okay, per stock. So your price actually comes down because of the discounted price of the offerings. It differs from different entitlements. More the number of shares, lower the price, obviously the TERP would change. And the last one, which is the value of the rights. The value of the rights is also calculated by the hedge fund to understand what would be the value of the rights. Let's say the same example, the number of shares is 100,000 shares, pre-rights, the price is $10, the value is $10 lakh, the rights is $20,000 multiplied by 7, $1,40,000. The post-rights is $1,20,000. The price is 9.5, we just derived that, the TERP, that is the temporary ex-right price, you get a value of $11,40,000. The value doesn't matter in the value of the rights. What we find out is the price. The market price is $10. The TERP is $9.5. The value of the rights is $0.5. So every right is valued at 0.5. What is the purpose of this? You want to find out whether the rights ratio is favoring you or not. Okay. So this is a game that issuers play as well, because they want to know what is the price at which investors would be interested in buying the rights entitlement. And finally, the most common mistakes made by fund accountants is understanding the entitlement ratio, which I have already explained in great detail. Rights entitlement is not shares. It doesn't automatically come into your demat accounts or into your custodian accounts. They have to be applied for, sold, renounced, etc. Okay. So thank you very much for watching this video. If you have any comments, please share your feedback and do let me know if there are any other topics that you would like me to cover in this field of global markets, operations, regulations and settlements. Thank you very much, and thank you for your patience for listening to so much of content on this long video.